So you're in the bond world and you're looking for companies that are the kind of companies that are not going to go out of business, I would imagine, but are the kind of companies that are needing money, are needing to borrow money. So there's kind of that like middle ground of companies.
Not quite. You're close though. You want companies that are not going to go out of business. They're already borrowed the money. They've borrowed it. And now, because of something going on in their industry, you know how much we've talked about events, right? There's an event. Okay. So there's some kind of event going on that jeopardizes the future of this company. So their bond rating is going down for some reason. I'll give you an example. A few years ago, a company called CF Industries was building a new plant on the Mississippi River to produce fertilizer. And CF is almost a toll bridge. I mean, they're a fantastic company. They have a huge price moat on nitrogen fertilizer. Biggest company in the country and the best price. So they've got a great moat. They're a great long-term business. But they borrowed a huge amount of money to build their new plant. And then, and they did it when corn prices and soybean prices were completely high, really, really high. And farmers were planting all the way to the hedgerows. Every single acre they could get corn into, they were planting it. And so the demand on fertilizer was huge. And these guys, so they could go to the bank and they could go, hey, look what's going on. We're making money hand over fist here. This is a great time for us to build a nitrogen fertilizer plant. And they borrowed the money to go do it. It was about a 4 or 5 year project. And by the time they got to about year 3 of building this plant, nitrogen fertilizer prices had collapsed because corn prices had collapsed. The whole thing went down like crazy. Okay? And then all of a sudden, these guys, their earnings are just really low. They've got this big debt. And the rating agencies, Moody's, Fitch, these guys who look at the bonds and the quality of the company behind that the bond, lowered their bond rating and said basically to the whole world, these guys have now become a real risk. And this bond has gone from investment grade to junk grade. Mm-hmm. Ooh. And so now at that time, it didn't collapse the bond, but if this happened right now, given what interest rates are doing, they're starting to climb. They're not dropping. 3 or 4 years ago, they were dropping. Mm-hmm. Now they're starting to climb, and you add that in. Oh, you just went to junk bond status and interest rates are climbing. It could very well be impossible for this company to refinance. If that bond came up if it came to the end of its life and you have to continue building your plant, which is useless to you unless you finish it, and you have to get the money to do it, you could be in real trouble. Or it would appear to be that you're in real trouble. And so people who own these bonds are in a very illiquid market, and they're like, I am out of here. I am so out of here. I'm gonna take a loss on the bond, right? Done. I'm out. It's just like you would take a loss on that $100,000 by having to sell it right now, except way worse because it's not a treasury note, which is very liquid. You can sell it anytime, any day. A corporate bond, one that just has its investment grade rating reduced to a junk bond, who's going to buy that? And the answer is Howard Marks will buy that if he believes the company will go right on through and be successful. So he's looking for these opportunities where the company's not going to fail. The bond price has collapsed. And he can go in there and buy that thing. Let's call the total value of the bond and interest rate and everything else, let's call it a 100. And Marks can go in and buy these things at 30 or 40. And there's your margin of safety. Think about it, because when the company's successful, it pays off. The bond goes back up to full value. They just doubled their money on the bond.
Yeah, absolutely. So It's really the same, what you're talking about. I thought you were talking about sort of general bond investing, bond purchasing. But it sounds to me like what you're actually talking about is really the mirror image of our style of stock investing.
It is. And
so you're waiting for a company that is going to continue, which is the part that requires the decision making, obviously.
Yep.
but that is having...
Do you understand it? Is it durable? Is it good management? Right?
Yeah.
The three critical things. And Marx
but is having a
very good
serious problem at the moment that you can see how it will get out of.
Yep.
And at that time you can... their stock is going to be the same, right? Their stock's going to crater. So it's just... What?
So
different strokes for different folks?
Yes and no. I mean, no, it's not so much different strokes for different folks. It's different strokes for the same folks. And that was the point of Buffett's letter in the early 80s, is that he was doing that.
Oh, around to the full circle. I love it.
So he was doing that, and very ambivalent in the early 80s about whether he would prefer to own the company or the bond.
Yeah. Well, to me, like, obviously he shifted towards stocks since then. And to me, the big difference is that bonds have a fixed amount of time period and stocks don't.
Mm-hmm. That's right. That's right.
And that's Buffett, really, really, really big difference.
It's a huge difference.
You're betting on how long it's going to take them to climb out of that hole,
right.
On what's going to happen in the greater economy. Like, there's so many variables, and it's often, as we've seen many times, really, really hard to predict the amount of time it's going to take for something to happen. And we've talked about that with short selling excessively. We've excessively talked about that.
So there's something that you have to
guess
consider.
that something's going to happen in a certain amount of time.
But that's the beauty of this bond thing. And that's what we still have to cover. And that is that, do you know, when you, let's talk about it in terminology we already use. So we would like to put a price on a company. We'd like to put a 10 cap price on it, right? Mm-hmm. And a 10 cap price essentially means that I'm buying this business where the owner earnings that come into my pocket represent 10% per year or better.
Yes.
Okay, so just like we would go buy a house across the street, deduct the expenses of renting the house to somebody, whatever we have to pay from our side, including taxes and insurance, right?
And if anyone who's listening wants more details, you can go straight to our book, InvestED. How about that for our plug?
We write about this heavily.
There's a whole chapter on it.
Yep.
There are 2 chapters on it, I think.
So this is a really good anchor point for you guys to understand this thing I'm going to tell you about bonds, is that the reason that we like this 10 cap price for, let's say, a house we're renting across the street. So you're literally getting, you bought the house for $100,000 and you're getting $10,000 a year net after you're paying property taxes and insurance and so on. You're getting $10,000, okay? Pre-tax, your own income tax, but you're getting 10%. Okay, the reason that we love that kind of a buy price, the reason that signals a good price to buy that stock is because on that family home across the street, we're not really that deeply concerned about whether it's going to be worth more in the future. What we're really looking at is that 10%. That's fabulous. We're getting $10,000 a year. And by the way, we can probably increase the rent on an average of, the rate of inflation, 2 or 3% a year. And so we know that as the rent goes up, the value of this thing is going to go up over time, right? But forget about the value of it over time. We're going to hold it forever. Right? That'd be the wonderful time to hold it, is forever, and just get this rent. We're happy to take the rent at 10% and growing to 20% someday and 30% someday down the road. Okay, that is what distinguishes bonds from the equity, is that with the bond, you're actually getting the money. So this corporation is paying out the money.
Got it. Good point. Very good point.
So now remember that you...
Explain that a little bit.
Okay, so when I buy this corporate bond, I am getting an interest rate on that corporate bond of, let's say, 10%, right? CF was having 10% loans. All right, so now I'm getting 10%. I put up $100,000 into this bond. I buy let's say a piece of this big issue that went out there.
Yeah.
And I get I put up my $100,000, I get $10,000 a year on this corporate bond. Okay. Now.
And I think we talk a lot about getting returns and all sorts of, per year, this, da-da-da. when it's not actual money that lands in your account.
It's theoretical
and
money.
This, right, we always talk about it like it's real, but it's mostly theoretical unless it's dividends.
This is not theoretical.
This is not theoretical.
You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.